So this is investments, principles of investments, kind of implies introductory. I'm Ron Sweet. My contact information somewhere in there. So Ron Sweet, I've been at UTSA, I don't know how long, at least 30, 25 years, maybe 30. I haven't kept track. Part of the time when I started, I was working at USAA. So my first several years, I taught and worked at USAA. Retired from USAA in 2009. I was head of equities, which what is equities? Stocks, bonds, real estate, stocks and real estate. So what does equities mean? You own something. Whereas bonds, you're loaning someone money. So I didn't like head of equities because I was only head of stocks. But equities includes real estate, but for some reason they said I was head of equities. So ran mutual funds, which I hate. I don't like mutual funds. We'll talk about them later. I don't really like stocks. I like bonds better, but they made me head of equities. So retired in 09. 09 is an interesting year, isn't it? 09 followed what? Recession, the Great Recession. So one of the reasons it was so good for me to retire, I announced my retirement in January of 2008, not realizing what 2008 was going to be like. They took a year and a half to replace me. Some of y'all might know John Toohey. He's the one that replaced me. They hired him. So they gave me a year and a half. And so they gave me 2008 as my last year. I was like, worried, thanks a lot. But it was my best year ever. I'm a risk adverse person. And so I actually did really well in 08. And it's probably good I retired in 09 because I wouldn't have done well with the great rally afterwards because I'm too risk adverse. But it was a good time to retire. And you have to do that in finance. You have a great year in finance, you retired. And they think you're a genius and they have no clue that you don't have a clue what you're doing. So I spent a lot of my time on the investment side, fixed income, bonds, real estate. I've dabbled in currencies and some other things, hedge funds. So I've done a lot of things. I've never done cryptocurrency, so we're not going to talk much about that. I don't have a clue what that stuff is yet. I've read many articles and I still have no clue. So that's how over my head that stuff is. I'm glad I haven't bought any, at least in the last several months. So we'll talk through a lot of stuff. It's an unusual class and you'll see, and I'll walk you through to make sure you can be prepared for the unusual exams and papers. So everything you need, I'm going to give to you so it's real clear. So you just got to put the work and time into it. I don't have an office, but you always find me in the Financial Studies Center on the first floor. If you don't know where that is, you should. If you're a finance major, every finance major should know where that is. You should be living in there. There's a few of my students who do live in there. William sits in the same place. I'll see him every single day in the exact same place. Why is that so important? Because that's where the Bloomberg machines are. The hub for the investment society allows you to teach yourself a whole lot of stuff. So you can find me there. I don't know what my office hours are going to really be. I'll be here every afternoon, Monday through Thursdays, but you can contact me anytime. So I'm on a bike every single morning. You want to call me when I'm on my bike, it's fine. Every morning. So usually by 7 o'clock, I'm on a bike. You can call and text me on the weekends, email me, and I'm very good at getting back to you. So if I don't get back to you pretty quickly, it's probably I lost your email somewhere, and especially text. I'm really bad at losing text, but you're free to call me. I don't mind students calling me. I have very lengthy conversations on my bike. I'm doing career advice for students. I do that quite a bit. So we'll find the time. And once I figure, one reason I'm not exactly sure is I'm the faculty sponsor for the Investment Society. And they do a lot during the week, but I don't know their schedule yet. So it's going to have to I'll let y'all know as we get closer into that. So this is a class on investing. Let me walk through a little bit what the class involves. It's pretty straightforward. So there are 2 exams. It says 4 papers. It's really 3 papers, but the last 2 count. They're 1 paper and combined, they count twice as much. And in class participation, attendance is part of it. Attendance is required. This is an in-person class. I do take attendance. Those last night, you have to hear my still on that again, but I take attendance because it keeps unengaged students from taking my class. And I don't want unengaged students in my class. Like just kind of this bias that students, I've had students that have graduated knowing as little as possible. That was their goal for 4 years of college. That's fine. That's an achievement, I guess, right? That you can graduate and not know anything. But those aren't the students I'm interested in. I want students that are just like passionate about finance. They just can't wait to talk about it. They're into it. So I love that. When I was at USAA, after I retired, they invited me back to a party. I go to the party, and within 5 minutes, we're all in the living room talking markets. And the spouses who weren't finance people, they're like, why are you talking markets? You did this all day long. I said, yeah, we're going to do it all night long too. That's all we did. We just talk markets. What's the Fed doing? That's what we live and breathe. We loved it. It's, so if you're a finance major and you're not like that, then you probably need to change majors, because this is what you're going to do next 50 years of your life. So, so I get into this. So I want students that are engaged. So that's the reason I count attendance. It also helps me learn your names, and I want to learn your names as quickly as possible. So we'll do that. We'll do a seating chart here pretty quickly. We also have a team competition that can actually add another 2% to your grade. So if you have perfect attendance, you can get 2%. And if your team wins, and we'll assign the teams before Monday, if your team wins, you get another 2%. Last semester, it was down to 3 teams on the last day, and we had our competition, and one team won, mainly because there's one person on that team that's just prepared for every question, and that he saved his team. I could always say, he would always catch me in the FSC. Oh, the question for tomorrow, what exactly are we doing? And he always was prepared. You could be the hero of your team by just coming prepared. You must say, well, I don't have the time, but most of the team competition questions are exam 2 questions. So you got to learn it anyways. So you might as well learn it for your team and become the hero of your team. But we'll do that, and we'll work that out in here. And then the course survey, you can get an extra 1% for that. The 2 exams, the first exam is really bizarre. I'm going to walk you through that step by step. Some students do really, really well on it. Some students completely bomb it because it's so different than any other exam they've ever taken. But I'm going to walk you through it. There's very little math. There's only one formula in exam 1. Exam 2 is all math, so they're very, very different. If you're a math person, you're probably going to prefer exam 2 or exam 1. Exam 1 has 2 questions. One exam question is essentially summarize 18 pages of my notes in your own words. So that's pretty straightforward. And then the second question is applying all of that to a very specific question. So if you understand question 1, question 2, you already know. So, but I'll walk you through that in detail as we go. And then exam 2 is just lots of math. Papers. So the papers in this class are very real life papers that you do on a job. So I don't know how your LinkedIn looks. How many papers do you have on your LinkedIn? What is your portfolio? Just one from last semester? Yeah, so how many papers? I had a student from this class. I just talked to him last night. And he says, I just did an interview, and the last paper in this class, well, that really helped me in the interview. They were really impressed with that paper. It's like, yeah, it's real life stuff. So you need to have, I don't know how many papers, but you need to have several. Carlos took my secure analysis class. That's one paper, but what, 40, 50 pages. So it's a pretty massive paper. I've had several people that took that class get a job only because of that paper. In fact, I had one employer interview one of my students, said, well, I'll interview her. She's really not qualified, but we'll interview her, just, be nice. And they hired her on the spot once they saw her paper. So, oh, wow, that's pretty cool. So you need to have that kind of thing. You need to be able to prove to employers you can actually write. It's also a huge advantage because a lot of colleges have stopped doing papers because professors hate grading. So you have a huge advantage. I've talked to students at other schools and they never do papers. So hopefully you're writing a lot of papers here because that's what you need to get on LinkedIn. So you'll have 3 papers in this class that you can put all on LinkedIn and really, really distinguish yourself. So we'll talk through the papers today. As far as the class itself, so you see the description of the papers. We'll talk through each one of them as we get there. So we're going to do question 1 on the exam is on asset classes. What's an asset class? Well, we just talked about it: stocks, bonds, real estate, commodities. So we're going to talk through those, and then that's going to be question 1 on exam 1. Is essentially it's a template, and it's a conventional template. So I'm not giving you wild stuff. I'm not going to show you stuff that's really, kind of cutting edge. So it's very conventional. It's what most people think, probably 99% of finance think. It's a good question to have because it's a very popular question in interviews. So if you're ready for this exam question, you might also get it as an interview question. It was pretty hilarious. A few semesters ago, USAA came and interviewed students, and they interviewed several students from this class right during the first exam. And that was the question she asked them was the question on the exam. And she saw me afterwards. I knew her from USAA. She's like, wow, these students are amazing. I was like taking notes, not because of the interview, but I was like, go home and fix my portfolio. She was just amazed. So there's like 5 questions you get a lot in finance, and this is one of those 5. It's the question of someone comes to you with $500,000 and says, what should I do with it? How do you answer that question? That's what that question is. All right, so we're going to walk through that. It's going to take us several classes to do it. But this paper 1 preparation we'll probably do a little bit later because you can't start it until February, and you'll see why on that. And then after we do that, we're going to just start talking different asset classes, some valuations, some numbers, end up with one of my favorite topics, which is options and derivatives. So I'm just going to walk through. It's a little unusual. There's stuff I'm supposed to cover in this class that I don't cover because no one does it in finance. And I'm like, if no one's doing it, I don't want you to, you can learn it yourself. You want to learn the Sharpe ratio, that's fine, but it's not used all that commonly. And so I'm showing you the stuff. I'm more of a practitioner. I'm not a research professor. So I'm showing you the stuff that's not in the textbooks that you actually do in real life. You'll notice we don't have a textbook. If you want a textbook, there are some good textbooks out there that you can certainly go and get if you want to add. If you want to spend $300 on a book, which no one in their right mind would do outside of college, there are books out there. Or buy a really good book that's an old edition. It's perfectly fine, but you don't really need a book. You have my notes, and I'll certainly give you some things. You can go to Wikipedia, Investopedia, and look them up if you don't like the way I explained it. If you don't understand convexity, then Wikipedia does a great job on convexity, and you can figure that out from there. So questions up to that point. You see what you're up to. 2 exams, 2 papers, 3 papers. We'll be working through my notes. But they're not cumulative, but there's a lot on them. But you'll know exactly what's going to be in the exam. There's not going to be any. I don't like classes where the hardest part of them is ambiguity. There's no ambiguity. It doesn't mean the stuff is easy. I expect really, really great, complex stuff out of the class, but there won't be any ambiguity. On the final exam, I tell you exactly what's on it, and I give you a YouTube that works last semester's final exam. So it goes through step by step. So you should all make 100 on the final. I haven't had that happen very often, but you should, because it's everything you need is on the exam. Other questions? So paper 1, you really can't do anything with paper 1 until February 3rd because it's a paper on the payroll report. But they start getting you thinking so you can get into it, start watching markets. The single most important economic report that comes out every month is the payroll report. Markets reacted more than any other report. It's probably going to react pretty strongly to the next one because there's so much focus on whether we're in a recession or not, so much focus on inflation. So it's going to be pretty heavily watched. So the paper is pretty straightforward. First of all, I want you to get in the habit of watching economic reports. So they're out there. There's a lot of them out there. There's others that are important sometimes, but other times they're ignored. Like the ISM comes in the same week, but a lot of times the ISM is ignored because it comes out as expected. It only moves markets if it's a surprise. And there's others like retail sales. I think retail sales today came out and had some interesting numbers. Sometimes it's important, sometimes not. Retail sales can be important after the holiday season to see how much shopping people did in November, December, those kind of things. So it kind of depends, but the jobs report is always important. Doesn't always move markets, but it's always important because it's a very, very strong indicator. Now, most of y'all have taken some economics, I think, haven't you? Are you taking economics now or money and banking now? So are you familiar with leading economic indicators? You've seen that in your eco class. So there's leading indicators, lagging indicators and coincident indicators. What would you think employment is? So leading indicator tells you about the probability of recession in the future. A coincident one tells you you're in a recession. A lagging one tells you just came out of recession. What would you think employment would be? I would probably get it wrong if I were where you are. What would you think? Is it telling you where we're going, where we are, or where we've been? Yeah, it tends to be a lagging one because firms react slowly. They don't like laying people off. They hold on to them. And once the recession is full blown, then they're really going to start laying them off. So it is a lagging. The ISM, I mentioned ISM. ISM is by nature a leading economic indicator because it's a survey of production managers asking them, how do you see the next 6 months? So when you look at leading economic indicators, I don't know if they say, but here's is right here. How does that look? Doesn't look very good, does it? So you notice when there's a recession, you notice what the leading indicators do. Do they go down during the recession, before the recession, or after? Pretty good indicator, aren't they? Even in the 2020 with the pandemic, the leading indicators actually, they nosedive in March, but they do a pretty good job. So what does this look like now? Why are so many people saying we're going to have a recession this year? That's probably a big part of it. All right. But the employment report is not a leading indicator. It tends to be lagging. It tends to be old news, but the markets still look at it as an important number because it just captures so much of what's going on. So, which means you might want to look up LEI and see what the factors are. One of the most important one is the yield curve. Is the yield curve positive sloping, flat, or negative? What do y'all think it is right now? And how negative is it? So hopefully in money and banking, you're spending a lot of time on that. So how does that look? Does it look upward sloping, downward sloping, or flat? It's a pretty negative yield curve, isn't it? So you as a finance major, get ready for interviews. What would I do if I were you? I would go out and look at this historically. And how could you do that? Well, most people, it depends on your source. Some people compare the 10-year to the 1 year. More common is the 10-year versus the 2-year. Some people do the 10-year versus the 3-month. But the 10-year versus the 1 year, I like doing because there's more data. You can get the 1 year back a very, very long period of time. So you can very easily go get 10-year and 1 year treasury yields back to the 1960s and actually subtract and see how negative it can get. So one thing you've got to get comfortable with before you go on an interview is when something's shocking. We're going to talk more about that today. Is this incredibly unusual? Is it normal? What's the normal sense? So right now, this is 4.6 versus 3.4. That's 1.2% or 120 basis points. That's a pretty extremely negative yield curve. So you saw the LEI, the leading economic indicators. One of those indicators is this yield curve. And so you can see why the LEI is showing recession because the yield curve has predicted every single recession we've ever had. We've never had a recession without a negative yield curve. So it's a very, very good predictor. And that's why so many people are saying, I have a good friend who's an economist, and I asked him, is the recession a result of the yield curve? Did the yield curve cause a recession? And he said, yeah, the yield curve being negative can actually cause a recession because people are reacting to that. It's kind of these self-fulfilling prophecy kind of thing. That's a very negative yield curve. What if we go to a period of time where the economy is really recovering, or even better? Let's see if I can. It will let me. I don't know if it will let me do this. How does that look? What kind of yield curve is that? So you've got steep, upward sloping, flat, negative, steeply negative. What does that look like? So you really don't know, right? Because what's the normal relationship? 10 minus 1. Is it 1%, 1.5%, 0.75%? You know, so you have to kind of get that knowledge. But right here, the 10-year is at 255. And the 1 year is at 178. So it's about 70 basis points. That's fairly normal for yield curve. So that's a fairly normal looking yield curve. What about 2007? How does that look? Before the 2008 recession prices, what was the yield curve telling us in 2007? This is actually early 2007. It's pretty interesting how the yield curve, it predicts and it just shifts so erratically. And then you get into the recession. I wish I could put Lehman. I don't remember what date Lehman was. You get into recession, it starts recovering because the yield curve is a predictor. So the yield curve is telling you we're going to come out of it. Why? Because when we get in a recession, so the end of 2007, into 2008, the Fed's already cutting those short rates. So the short end of the curve is coming down, and the long end saying, hey, we're going to get recession, we're going to get recovery, it starts going up. So the yield curve is telling you recession is coming. When you get to the recession itself, it actually starts coming back. So it's kind of interesting. All right. So if I were you, as a finance major, I would definitely be looking at those leading economic indicators. I would learn them. What are they? So those are the factors I would be following. I would also look at the coincident and the lagging. So why are those so important? Well, you're taking the best economists in the United States, the smartest people we have, and they're saying those are the most important factors to our economy. If they're saying that, is there a chance they've got something intelligent to say? Hey, these are people with PhDs in math. They've been studying this for years. Yeah, I went to an economics conference when I was at UTSA. It was an inflation conference. Oh man, that was stupid. I sat there like I have no idea what that guy's saying. Boy, just math after math after math. I understood a few presentations, but boy, it was a rough. These are very quantitative people, very statistical people. They have to have proofs. So there's a good place to go if you want to know what's the most important, talking to interviews, those are the kind of things to look for. So this is just one of them that we're going to look at. It's one of the most important ones, the jobs report. There's two parts of the jobs report. There's the jobs and there's the unemployment rate. So have y'all heard household survey? Does that sound familiar? So the household survey is the unemployment rate. So the household survey, they go to the households and they ask them. I was actually part of the survey. It was funny. They called me and said, hey, we're federal government, Department of Labor. Would you be willing to be part of the household survey? I was like, you bet. Boy, that would be a great experience. So this guy shows up to my house. If I'm not there, he leaves a card. He comes back and he's not going to give up until he talks to me. And he asked me, did you work last week? If I say yes, then I'm unemployed. If I say no, then he asked me, did you want to work last week? If I say no, I'm retired, I didn't want to work last week. Then he says, you're not employed, but you're not unemployed because you're not part of the labor force. Right? So if I'm 3 years old, I said, did you work? No, I didn't work last week. Did you want to? No, I'm a kid. Obviously not. If I'm 98-year-old, did you work last week? No. Did you want to? No, I'm retired. If I'm 27, then so that's the labor force. Then it becomes more important. Now, with me in the summer, it got really tricky because I don't teach in the summer. So yes, did you work last week? No. Did you want to? Well, no, I'm on summer break. Well, am I unemployed? Well, no, I'm not unemployed, but it is. I didn't know what to tell them, so I probably messed up that report. But it got a little tricky for me. So that's a household survey. They actually go talk to households. The other one's the jobs number. That's where how many jobs were added. That is a survey of corporations, and it's actually probably the more important of the two numbers. Markets react to that one more than they do the unemployment number. So that's a good number for you to go back and look at historically and see what a normal number is. So you don't want to go into the interview on the jobs day and 450,000 jobs were added, and you walk in the interview and they say, wow, what did you think about that job report? So something big happened, but you don't know what to say. I mean, you can probably try to fake it and say, oh yeah, wasn't it interesting? What did you think? You can try that, but that's not going to get you the job. You say, what does 450 sound like? Is that a good number or a bad number? What do you think? 450,000 jobs? That sounds strong. That sounds pretty strong. So the normal is 150, 200 types of jobs. So 450 would be really, really strong. You go back to 2020, we were releasing millions of jobs. It's kind of an unusual period of time. So you kind of have to know what is that number, but there's also the expected number. What did we expect to add? And so that's what the market is looking at. So you're going to talk those two numbers. The jobs number gets revised and gets revised dramatically. So that's the other thing you have to look at in the jobs report. Not only what was expected and what was reported, but you also want to know, was last month revised? That's pretty critical as well. The unemployment rate does not get revised. So if it comes out at 5%, it's 5% forever. They don't adjust that number. So that one, and the reason they get revised is they have more surveys to do and they're getting updated numbers on the jobs report. I mean, the household survey, they don't report it until they get the survey. There's nothing else for them to adjust. The only thing they could adjust on that is their seasonality adjustments, if they change their formula for some reason. And I think they may have done that a couple of times. So again, you want to know what's the normal number. 9% unemployment, that'd be pretty bad, wouldn't it? 2% unemployment, boy, that would be inflationary, pretty rough. So let's look at the last jobs report so you get a little bit of a sense. So I gave you a link to this calendar, and it's called the employment situation. See, the ISM came in, the ISM comes in also right here. So there's other reports. So the first week of the month, so the employment report comes out the first Friday of each month. And there's other reports that week. So that first week's pretty critical. I've heard that, but I don't follow it. So it's a pretty new one. So
a friend of mine who's a CFA, she recommended.
Yeah, I think William was telling me about that. It's just not one I follow. So I've been retired for 13 years, so I've missed some of those things. I have to look. Yeah, that's the one. Was it Goldman or someone who created? I forget what firm created. So yeah, there are some new ratios, and you want to watch those. That's kind of the advantage of me being in the field, because I'm talking to people all the time, and they're throwing me stuff like that. So yeah, there's probably other ones out there. This is a great website that you probably should start looking at start getting into this. You're going to do this for the next 50 years of your life. So you got to start learning it, reading it. It's like a mountain of stuff to learn. It's too much. So what do? You start. I remember my first jobs in finance, boy, they're scary. You feel so stupid. Have y'all been in a new job where you just feel so stupid? Everybody else is running around and you don't know what to do. But then 3 months later, you're like, you got to figure it out. And it's amazing to me. You sit there 60 hours a week and your brain just starts learning stuff. And then 3 months later, you're the person that knows everything. And the new person's coming in and going, wow, I wish I knew what you knew. Think, well, I've been here 3 months, but it's the learning curve is massive. But can you preempt that and start doing it now? So you start doing this stuff now, so you're not putting all in that first day on your job. It's pretty cool. In your first job, you walk in like Lance and you say, hey, what about this index? And they say, oh, I haven't heard of that. That's pretty impressive. Your first job, you're already showing them something. So start reading, and reading's the key. I put my book reading list, recommended list out there. You've got to be reading. We read in finance. It looks like you go into my department when I was there, it looks like no one's doing anything because everybody's sitting around reading, but it's what you spend most of your time. I've had people I work with that they have a new baby and they'll go home with a stack of books and they're reading a book with a baby in one hand and they're just reading. That's what we do. We read a lot. I figured out how to read a much more efficient way because I spend 4 hours a day on a bike, and that's when I do all my reading. Not with paper, but with podcasts. And I read The Economist every week. I love The Economist. Great periodical. I read books. I got several books that are really highly recommend. So get in the habit of reading. Guess what? You probably won't be reading when you graduate. Textbooks. Textbooks are horribly written. I'm just so shocked at how poorly written they are. They're out of date. And I used to teach a class, business finance, where we're supposed to use a textbook, and I did. And the multiple choice questions, it's like someone with no knowledge of finance read the textbook and made up multiple choice questions completely out of context. Like, because no one in finance would ever think like that. So you got to get out of the college student mindset and get into the professional mindset. And this is how you do it. You read these type of reports. So let's click on this employment. Factory orders, that's a big one too. ISM services is not as important as ISM manufacturing. ISM manufacturing is part of the leading economic indicators. Mortgage applications, what are they doing? Mortgage rates are up. they've been coming down. That would be interesting. So let's look at the employment situation. Whether they'll let me do it or not, they keep changing their websites. So they may not let me do it. Let's try one more time. Yeah, so I may not be able to get into it. So there's December, added 223,000 jobs. Does that sound good? Doesn't sound bad. Sounds pretty normal. The Department of Labor does this. If you go to their site, they'll give you a much more detailed description of what's going on. Probably too much, probably overkill. They go in details. You don't want to give this to your boss, but it might give you some insights. There's the unemployment rate. There's COVID. See that jump from 4% to 14%. I mean, it's pretty amazing when United Airlines revenues fall 80%. They're probably going to have to lay some people off, more than likely. So then it drops, but look how quickly it recovered. And we're back down to some pretty amazing. Here's the jobs added. You can see that this is actually the number of people employed, not the this is not the actual jobs added. So the jobs report is giving you the change in that number. This is the total number of people employed. The jobs report is saying how much did that change. These are seasonally adjusted, which means COVID really messed this thing up, because how do you do seasonal adjustment when you have COVID? Really tough. We know teachers come back to work in August. We know there's certain jobs related to summer vacations. COVID messed all up. My economist friend, he's actually pretty famous for his forecast. And one of the things he really harps on is we're not doing seasonality adjustments correctly. And he had made some suggestions on that. But yeah, COVID really messed up. How do you do seasonality when everything's just not normal at all? All right, I wish I could show you the actual report. There's probably other places out there that show it pretty well. Let me try one more link. I did give you a few links at the bottom here. Let's see if this one will work. When we get the actual report, I'll show you the actual report as we get closer. So the question is if you can find the actual previous month. Let's see if it'll let me do that. December 19th. We got to go back further than that. December 21st. No, it won't let me get back that far. Let's see if we can do January. January 5th. Getting close. January 6th. There we go. Unemployment report. So the actual came in at 3.5%. The previous was 3.6. The consensus was 3.7. So on the surface, does that sound like a strong report or a weak report? You want unemployment rate to be high or low? You're Biden, kind of want a low number. It came in below the previous month, and it was below expected. Consensus thought it was going to increase from 3.6 to 3.7. It actually came down. Jobs, 223. The previous was 256. They were expecting 200. Came in essentially as expected. They don't show you here if the previous was revised. Participation rate, extremely important. You're going to talk about that in your paper. That's that thing. A participation rate is how many people in the working age are actually want a job. So you have 100 people, but 40 of them say, hey, I don't want to work. I don't need to work. I don't want to work. So your participation rate is only 60%. All right. That rate has been doing some really wild things since COVID, but even before it's been coming down. Why is it? Maybe the baby boomers are retiring. Some of it was the economy was weak. And so the people saying, I'm not working anymore. I'm going back to college. There was things hitting that, and that number has really dropped quite dramatically. So that's a pretty important number, because if that number goes up, if more people say they're participating, it can cause the unemployment rate to go up. Not because the economy is doing badly, because it's doing well. Because, hey, I'm now looking for a job. The economy is really strong. I'm going to go back into jobs force, but I don't have a job yet, so I'm unemployed. So you have to watch that number because it can actually help explain why the market reacted positively to a number when it actually went up. So you have to be careful on those. Earnings can be important because of inflation. Are employers having to pay their workers more? So you would want to watch that number. And then where do the jobs come from? They split up manufacturing. I don't think that's all that important anymore. So you might want to look and say, okay, we added 200,000 jobs, but did they all come from one industry? Is it all healthcare? Is it all education? Where do these jobs come from? I remember 1 month, the number looked pretty bad, yet the market reacted positively. And when you looked at it, the reason the number looked bad is because governments were cutting workers, but industry is actually adding workers. And it's because back during, I forget, some financial crisis where governments were just cutting teachers and firemen and police, but corporations were actually hiring. So they adjusted that number. So you have to look somewhat in. They do break out government payrolls a bit separately. All right, so this is not the best. I'll show you the actual report, which is standard way they show it. I just can't get into it in that other website. I'll keep looking for websites. All these websites work wonderfully, and then they work so wonderfully, they start asking you to register and pay money, and then I can't use it anymore. So I'm trying to use as much free stuff as I can. This is such a well-known report that it's all over the place. So there's somebody out there that has what we're looking for, but they don't quite have that. So what are you going to do? So you're going to do exactly what your boss might ask you to do. So your boss, she's running late. She had to run an errand. It's Friday. She's got a meeting with the CEO at 9:30. Unemployment reports come out. She knows that's the first thing the CEO is going to ask her about. So she calls you and says, hey, I need a report on my desk, 9 o'clock on the unemployment report. And you got to make her look like a genius. You got to give her everything she needs to do that, right? That's probably the most important thing in your first job, is to make your boss look like a genius. If you try to make yourself look like a genius in your first job, you're not going to do well. Because then your boss thinks you're after them and your coworkers. So your job is make your boss look as smart as possible. So what does she want to know? Well, she wants to know, how do jobs numbers come out versus what was expected? Was it a positive report or a negative report? What does this mean for the economy? So right now we have two things going on. We're worried about a recession and we're worried about what else? Inflation. That's kind of bizarre, isn't it? Usually if we have a recession, inflation will be coming down. But right now we're worried about a recession and inflation. That's a pretty wild scenario. So you're going to be looking at numbers. You may get a good jobs report and the stock market doesn't like it. Why? Because they say, well, employment's still strong. That's going to be inflationary. The Federal Reserve is going to raise rates to slow the economy down. That's what we call good news is bad news reports. It could be a bad jobs report and the market likes it. Why? Because that means, hey, inflationary pressures aren't as bad. Is a bad report, but it wasn't so bad to be a bad recession. Have you ever heard of the term soft landing? So it's going to be a recession, but not that bad. Hard landing means a really bad recession. So I think the stock market's saying, hey, we're going to have a recession, but it's going to be a soft landing. It's not going to be horrible. That might be what the jobs report tells them, which means the Fed doesn't have to be so aggressive. Stock market might go up. You never know. Generally, a strong employment report, the stock market goes up and the bond market goes down. Weak reports, stocks go down, bond markets goes up, but that's not always the case. All right. And so one thing that helps to know, when do stocks and bond markets move together? And there's one key thing, and it's inflation. So there's three environments. There's a strong environment. In a strong environment, stocks love it, bonds hate it. A weak environment, stocks hate it, bonds love it. When's the one time they both hate it or love it? It's inflation. In the 70s, stocks and bonds did horribly. In the 80s, stocks and bonds did wonderfully. Why? Because in the 70s, inflation was rising. In the 80s, inflation was falling. Since then, the 90s going forward, they go in opposite directions. So generally, you would think a strong unemployment report, you should see a strong stock market and a weak bond market. Well, we'll see, because of the inflationary, you may get something unusual. I hope we get something unusual so you have an interesting paper to write. I hope it's just I hope we get a crazy, crazy report. So that's the first thing you have to do. You have to talk about the jobs report, unemployment rate, participation rate, and inflationary pressures. what industries, those kind of things. And then the second question is, how did the markets react? So there's two things you have to talk about there, the standard S&P 500 and the 10-year treasury. So the S&P 500 is the most important stock market in the world. That's what everybody talks about. If you talk about the Dow, stop talking about the Dow. We don't talk about the Dow. It was interesting, a couple of days ago, the S&P was flat and the Dow was down a bunch. That's unusual. Why did that happen? Well, because Goldman Sachs is in the Dow and it had a bad day. So Goldman Sachs was down 6%, Morgan Stanley was up 6%. Goldman's in the Dow, Morgan Stanley's not. Those two offset each other, but the Dow is only 30 stocks and it just happened to have Goldman. So the Dow is just only 30 stocks, so it can react really bizarrely. So it's the S&P with 500 stocks that you want to talk about. And then the bond market, why the 10-year treasury? Well, if you go to Yahoo Finance, you'll notice there's only one interest rate on Yahoo Finance. And that's the 10-year treasury. It's the most important interest rate out there. It prices mortgages, it prices the stock market, it prices a lot of things. It's the most important, it's most liquid bond, more than the 5-year, more than the 30 years. So you need to talk about the 10-year treasury. And then it's up to you. You got to pick some others. What else would you talk about? So look on that day and see what else moved a bunch. May give you some indications on what's going on with markets. I'll give you some websites that can really help you with that. You could even talk about an individual stock. So how could you do that? Let me show you one of my favorite websites. I love this thing. It's www.finviz.com, finviz.com. And if you click over here, they show you the entire stock market. It's the S&P 500, not the entire, but the S&P 500. And the box size is the size of the company. So how did the market do today? You've seen a lot of green today. Pretty red market. Microsoft off by 1.9%. That's pretty amazing. Meta's down 1.7%. I own Meta. That's not good.
When you said the size of the box, is it?
It's market cap, how large the company is. So Apple's the largest because it's a 2-point-something trillion company. There's a few green companies in there. mRNA, Moderna, they're up today. Who knows why? Up 3%. They may announce something. Who knows? Qualcomm's up. Who knows why Qualcomm's up today? That's kind of bizarre. But some of that can just be noise. They could have reported something today. So you might look at this and say, wow, it looks like tech stocks are really down today. Why is that? Why are tech stocks down? Or energy stocks are really down today for some reason. The other thing you can do with this, you wouldn't do it for this paper, but you can actually change this to do year to date. Year to date, which is only a few days, you can see it's a lot of green. Microsoft is still down, but Apple's up 4% this year. So what's going on there? You can also do, and I would remember this because there's a lot of people in the profession that don't know this exists. This could be the perfect thing to put in your first paper in your first job, and they'd be pretty amazed. It's really powerful. They even have the 1-year performance. Obviously, that's going to be a lot of red because the markets have been down, but then look at Exxon. What did oil prices do last year? Putin was like, here's a gift, oil companies give you that. And Valero is like up 59%. Valero might have been the highest returning stock the last 12 months. Here's San Antonio company. There's a few others. Eli Lilly's up 44, but for the most part, people are down. Meta, obviously, one of the worst, down 60%. That's why I bought Meta when they hit 90 bucks. I was like, wow, I'm gonna jump in on Meta here. But it's a pretty cool, pretty good chart. So interesting. Not only that, but they also have up here the futures. You click on the futures, you get a lot of markets there. So would you want to talk about gold today? So what did gold do today? So gold was down 0.19%. Does that sound important? Probably not that important. Y'all see anything here that might be important? So down here, they show you that the VIX is up. So you might talk about the VIX. Y'all know what the VIX is? I know the VIX. Volatility index. It's the implied volatility of the S&P 500 in the next 3 months. The VIX jumped a bunch today, so that means there's a lot of uncertainty. People are worried. What else moved a bunch? Natural gas fell 8% today. Is that because of the mild winter in Europe? Did Putin say something today? You know, that's the big fear, natural gas. What's natural gas been doing the last several months? So you can't actually click on some of these. And you can do a longer picture. I won't do that. Let me do daily. So you can see how natural gas has soared. And then here it's been coming down, probably because the winter has been pretty mild. But who knows? People are talking about what's going to happen next year. You can go longer term on these and just see natural gas didn't do anything for years. It just kind of stuck around that 2 to 4 range. And then you can just see Putin shooting that thing up. So you have a lot here you can work with. This is today. You don't know what's going to happen on your jobs report that you do. But you've got gold, you've got silver, you've got commodities, gasoline, oil, crude oil might be interesting. What did crude oil do today? Down 1.5%. That sounds like a pretty big move. Not as much as the stock market that was down 1.9% or 1.6%. All right, so FinViz is a good place to go. And then, you know, you've got Market Watch, Google, Yahoo Finance. There's plenty of websites you can go through that's going to talk about the market for that day. What you're trying to do is explain to your boss why did the market move like it did. So I'm hoping we have a crazy day we get a really good report and the stock market falls 2%. I think that'd be pretty interesting. All right, so here's something I want to show you. I'm sorry I don't let you out early in the first class. I'm too excited about this stuff, so kind of stuck with an obsessively obsessed professor. So one thing I noticed on this first paper is, as a finance person, I just assumed every college student just knew this stuff. And then I saw in the papers, like, wow, the students really struggle with how to express this. So when you talk about markets, I want you to think it in 3 ways. First, there's indices, usually for stocks. Then there are interest rates or rates, percents, usually for bonds. And then there are prices, dollars, say gold or oil. So how do you talk about this? I'm going to show you how you should talk about them because they're standard for the industry now. There's other ways you could talk about them that are not wrong, but if you said it in an interview, they would look at you funny. Right? Do you want them looking at you funny in an interview? Anybody? Is that your goal? It's like, wow, I went in there and I said so many strange things. They thought I was, no, that's probably not what you want. What do you want to sound like? You want to sound like a financial professional that's been in the industry for years. So what is the jargon? So an index, something like S&P 500, that's not a dollar amount. The S&P 500 is not $3,900. It's $3,900. So if the S&P went from 4,000, well, I mean, let me use round numbers, all right? Just makes it easy. Let's say if it dropped from 1,000 to 980, how would we talk about that, right? So it dropped how much? So the market dropped, well, 20 what? It's not $20. It's not 20%. So how do we say that? We say 20 points are 2%. Right? So when you talk about indices, you say how many points it moved. You don't say dollars. If you really you go on an interview and you say, yeah, the S&P was down $20 a day, it just sounds strange. It's not technically wrong because it's a buildup of a bunch of dollars, yeah, kind of in its index, but you just don't say that. I've had some students say it fell 200 basis points. We'll talk about basis points. That's not wrong either, but boy, it sounds like you're trying to show off. So you'd be kind of embarrassing yourself. We don't talk basis points. We don't need to, and we'll talk about that. So the market dropped 20 points or 2%. So someone help me out here. What did the S&P do today? So say the whole sentence, the S&P dropped 62 points or 1.56%. All right, you want to say all of that. The S&P dropped 62 points or 1.56% today. Now, is that a big day or a small day? So on the S&P, I'll tell you the historical standard deviation on a daily basis is right at 1%, makes it really easy. So you remember standard deviation, 2/3 of the time, it's plus or minus 1%. So 1% is a big day. This is a 1.5 sigma event. That's a pretty big day. It doesn't happen that frequently. All right. So if you're walking into an interview and the S&P's moved more than 1%, you're probably going to have to talk about it. It's going to be a big day. All right. Someone want to try NASDAQ? What did NASDAQ do today? Any volunteers? Keep going. All right, so NASDAQ fell 138 points or 1.24%. I have some students that say NASDAQ today closed at 10,957. That 10,957 was 138 points lower than yesterday. The NASDAQ fell 1.24. That's 3 sentences. You could have gotten that whole thing. NASDAQ fell 138 points or 1.24% to close at 10,957. I got it in 1 sentence. I have students that will take 3 paragraphs to say word, just tell me what you're saying. So like, based on a word count, with that, I don't do anything word count. More words is bad. Remember, what's your goal with your boss? You want her to look like what? You don't want to look her stupid so you can take her job, because she'll figure that out pretty fast and you won't last very long. You want her to look like, if you make your first boss look like a genius, you will do extremely well in your career. Now, your 3rd and 4th job, that's when you start kind of jockeying for position, but that first job, you just focus. It makes it the first job so easy. What can I do to make this person look like a genius? And if you do that, so how do you make her look like a genius? She's going into a meeting with the CEO. She can't flip through 40 pages of data. So I showed you what, I forget, I may not have kept it up there, but what the Department of Labor, so all that detail, you want to give her a bunch of detail that's not unimportant. Oh, I want to tell you, healthcare added 312 jobs. But why are you telling me that? It doesn't seem all that important to me. All right, so you got to figure out what's important. So it's critical thinking. My first boss and my boss's boss, he actually had a PhD in economics, but he also had an English degree. I remember one of the first times I walked in, I had a memo that was 3 pages long. After about 45 minutes, he got that down to like 2 paragraphs, and he said more in 2 paragraphs than I said in 3 pages. And I was like, now I get it. The goal is not for me to show off all my research that I did. The goal is to communicate. So that is your goal. You're communicating what is important. So you got to figure that out, what's important. So if you can get this in 1 sentence, you've told your boss everything they need to know. Do I need to tell her that it closed at 1,000 yesterday? Do you think she can add 20 to 980 and do that herself? That's probably well within her. If she's the boss, she could probably do that in her head. Do you need to tell her what the S&P 500 is? Do you think your first boss in finance will probably know what the S&P 500 is? I don't count off for that. I have students say the S&P 500 is a large, but don't do that in your first job. Your boss is probably going to be pretty upset. Like, you don't think I know what the S&P is? Are you kidding me? So yeah, you don't need to define what the S&P 500 is. Everybody in finance knows that.
So I guess the big stupid things, less is more.
Well, it depends. I mean, more can be more too if it's really important. So you got to decide. This is the critical thing. There's stuff you might leave out that you should have put in your paper. Now, I'm saying participation rate you should do, but that's obvious. But there may be some other stuff you should do that I didn't mention. So you've got to decide that. That's where you're moving from a college student where your professor gives you this rubric and you just do that, to a finance professional where you've got to decide what is important. Okay, let's talk about bonds. All right, let's say the 10-year was 3.5% yesterday and closed at 3.4% today. Now, if you go to Yahoo Finance, they do it wrong. So I'm just going to warn you, Yahoo Finance does it wrong. Yahoo Finance shows us negative 0.453%. What they're saying is the yield, it dropped 0.16. That 0.16 divided by yesterday's yield is minus 4.53%. No one in finance would ever say that number. Do not have that 453 on your paper. It makes no sense. Why not? Because it's so confusing. You do not, and you're gonna have this on paper too as well. Anytime you're talking about the change in interest rates, don't talk about the change in terms of interest rates. Don't say an interest rate changed 12% or 4%. It's really confusing. So what did this do? So treasuries, or the 10-year treasury, you want to be specific. The 10-year treasury yield fell what? What could we say? Yeah, Dante, you had my class last time, right? We talked about it some in there, didn't we? You probably knew it anyway, right? Did you see any, did you see your basis points in your interns? Yeah, I had one student, I can't remember who it was. He said, Professor, I'm glad you taught us basis points because that's all they ever said all summer. I just kept hearing basis points, basis points. So fell 10 basis points. As bonds, what did they do? Did they sell off or did they rally? Interest rates fall, what are bond prices doing? Going up as bonds rallied. So here you want to say fell 10 basis points to close at 3.4%. So what is 10 basis points? So 100 basis points is 1%. 10 basis points is 0.1%. 1 basis point is 0.01%. Okay, if you're not used to basis points, you just got to learn basis points. That's how finance talks. I've had a lot of jobs where, in fact, it's embarrassing when I was in my new job in finance. That guy who rewrote my paper, USA for the first time in its history had borrowed in public markets. And this chief corporate finance, the corporate treasurer, he comes out of his office, he's so excited because USA had no idea how the market was going to accept him. And he's so excited, he comes out of his office and I'm the only one in the office. So he says, well, I'm so excited, I got to tell someone. So he tells me, it goes, Ron, we got it 7 over. I'm going, that's great. You got what at 7 over, what is 7 watts over what? I have no idea what he's talking about. He looked at me like, why did we hire this guy? What an idiot. He was really a huge day in USA history. I had no idea what was he saying 7 over what? What do you mean? You may have a guess on that?
Basis points over what they expected.
Well, 7 basis points over, but not what they expected, but 7 basis points over the risk-free rate. So USA would borrow, if the risk-free rate was the treasury and it was 2%, USA was going to borrow at 2.07%. It was a really tight spread. He was really excited because USA didn't know. And here, unfortunately, I was the only one in the office that day. To my, kind of give me an excuse, I didn't know they were working on that. So no one told me. So I, from that standpoint, I had some excuse to not know what he's talking about. But he didn't even say basis points. He just said 7 over. Now, if you want to sound real fancy, what would you say? In the interview, you don't say basis points. You may know we talked about that in your class, Dante, I can't remember. BIPs, yeah, I think we're talking there. You say BIPs. Why do you say BIPs, BPS? So if you want to sound really fancy, yeah. So what did the treasury market do today? How much is that down? So Yahoo Finance doesn't do well. Is that 1.6 basis points, 16 basis points, or 160 basis points? What would you think? 16 basis points. Now, is that a big day or a small day? What do you think? All right, so here's something else. Put in your notes. The standard deviation of 10-year treasury yields is 6.7 basis points. 6.7 is one standard deviation event. So what did we get today? You walk into an interview today, do you think you might bring up the 10-year treasury? Yeah, that's a huge thing. It's almost 3 sigma event. And what did treasuries do today? Are treasury prices up today or are they down today? They're up dramatically today. This was a big, if I text my friends at Bakery Capital, I'm like, wow, great day today on the market. I better, be up 10 cents on my mutual fund today. That was a pretty massive market. That's a huge day in the market. So the stock market sold off a bunch and the bond market had a huge rally today. That's interesting. That's really interesting to me. That's something's going on. That probably means recession. That probably means the market saw something today where they worried about recession. We're worried about inflation. What does the bond market think of inflation? They hate inflation. So if today was an inflation worry, the bond market would not have rallied like that. So probably today was more recession news than it was inflation news. So retail data, PPI, Fed speak, and earnings. So what did the Fed say? That would be important to put into your paper if the Fed said something important today. So I can't answer that, but you can read these articles. That's part of what you're going to do is read articles, see what other people are doing. If you have an account on the Bloomberg machines, the Bloomberg machines are great for this first paper. You just get on the Bloomberg machine, log in, just type ECO, and it brings up everything related to economics. You can click on the jobs report. You also type news, and bring up all kinds of, you can type on news and say, I want all news related to economics, and bring up articles. You can type AV, and that brings you up interviews and videos. You can change that. I want videos related to economics. You can bring all that kind of stuff up, especially on the Friday this report comes up. If you go to the FSC on that day and get a Bloomberg, log into Bloomberg, you'll have all kinds of, probably more than you can read, that you can use for your papers. There's a lot of stuff out there. So a huge day today for the markets. So you may want to try this one. The 10-year treasury today. The trade, well, did I say it right? Let's see if I said it right. I'm going to mistype it because I'm talking. Yeah, no, I said it right. The 10-year treasury yield fell. So what did the treasury yield do today? Any takers on that? Y'all see it? Is it? Oops. Any volunteers? We'll do it again next class too to practice. Yeah, on the paper you'll say basis points, but yeah, that's to close that. So you want to put that in there. And then you want to say, as bond prices rallied. Now you notice with the stocks, I said stocks fell 1.56%. On treasuries, you don't say what percentage they fell because you don't know. There isn't a 10-year treasury out there. The Fed did not issue a 10-year treasury today. So what do we have? We have a 20-year treasury that was issued 10 years ago. And it may mature in 9 years and 11 months and 12 days. There isn't actually, so there's multiple of them. Some of them have a coupon of 6%, some of them have a coupon of 4%. We don't really know. All right. If you do Yahoo Finance, FinViz, you can look at the 10-year treasury and they'll tell you the 10-year treasury is up 1% today, but you're not going to use that in your paper. You don't tell your boss the 10-year treasury rallied 1%. So don't talk about the percentage change in the price. You just say it rallied. All right. You don't know exactly which 10-year treasury that FinViz is using. So on that, it's pretty good. You just have to say if the price is up or down and find an adjective or an adverb. Did it rally a lot? I would probably today say the 10-year treasury yield fell 16 basis points. They closed at 3.75% as the treasury market saw a very strong rally. I would really emphasize very strong rally as markets became more concerned about recession fears or whatever. Okay. You can see here, you could say that the market fell 200 basis points on the S&P 500, but you don't need to because the S&P 500 is not in percents. It's an index. All right. So we use basis points. So on the paper number 2, you're going to talk about margins. Margins are in percent. A firm's margins might be 30%. You want to say their margins were 30% up 150 basis points from last year. All right. So anytime you're talking about a percent, you talk about basis points. If it's not a percent, don't use basis points because it just sounds weird. And then prices, let's say gold went from So if it's in dollars, then it gets pretty simple. I don't know what if gold works here, but L $1 or 1% flows at 99. It's not a percent, so you can talk about the percentage change. And it's in dollars, so use dollars. So oil prices are down $3 a day or 12% or whatever, 2%. All right, so if it's not a dollar like an index, just talk to points and then a percentage change. If it's an interest rate, talk about the basis points change and whether the price is up or down. If it's an actual price like oil or gold or silver, talk about the dollar change and the percentage change. Okay, so that's what you got to do on the paper. Just be really, really clear on that. We'll practice this some more. Any questions on that? Get familiar with this and start practicing it by just talking to each other. Look at the market, start using this jargon so that, today, if you had an interview today, you better know all this stuff because they live and breathe this. If you come in not knowing, they're probably not going to be interested in you. If you don't know about market, and you may have an excuse because you're like in a conference all day or something, you just have time. You would probably want to give them that excuse pretty quickly. But this is a day if you would absolutely have to know about it when you walk into the interview. All right, so I'll get our teams going by Monday, and then we'll get into the class materials here. Any questions on anything?